So Julian and I would like to welcome our featured speaker, Mike Scarpa. Mike is a managing director in Waterhouse Coopers U.S. Financial Services Group. Mike specializes in risk management, regulatory reporting, and compliance. His experience includes work at the OCC. Mike, I hope you're going to provide some context for us and help make sense of what everything's going on.
I need to get your slides up so you guys talk. I'm sorry.
Sure. I certainly will. Many years ago, I started working as reg counsel for a broker dealer, and I was working with a former large bank examiner from the OCC who specialized in interest rate risk. And with the environment where it was and what we were doing, I said, is this stuff ever going to be relevant? Well, here we are, 10 years later, and interest rate risk is now at the forefront. The sleepy little interest rate risk that people didn't pay attention to came home to roost. And so I spent 2 years looking at ALCO models, looking at interest rate risk modeling, looking at liquidity risk management modeling. And a lot of what I'll discuss today actually harkens back to those days. I'll incorporate some of my experiences with both KPMG and now PwC, and we'll get into some critical topics that I think the banking community, the investing community should really want to understand as we move through, this banking turmoil that we're dealing with presently.
Okay, we're ready for your slides. Let me just share my screen.
Sure. If we could go to the agenda slide, I'll go through what we're going to cover today. And obviously, I want this to be as interactive as possible. I can't promise you that I know everything or will be able to answer everything. And if there are questions I don't get to, I will certainly do my best to write up a response. Today, I hope to cover, what is the FDIC? What is FDIC deposit insurance? Certain aspects of the call report that I'm looking at, that I'm interested in, interest rate risk and asset liability management, which I think is, top of everyone's mind at this point. Liquidity risk, which goes hand in hand. Contingency funding, what to do, when to do it. Resolutions and receiverships, probably not as relevant to a lot of you, but some good thought processes and those exercises that should be considered. And then where I see potential regulatory changes that could come about due to what's transpired over the last few weeks. If we could jump to slide 4, I can get into the FDIC, who sits on the leadership panel, what they're doing, how they're doing it, if that makes sense. So let me just make sure. Okay, we're on the slide. Okay, the FDIC, obviously headed by Marty Grunberg. It has a 5-member panel. Their primary responsibility is making sure that people who want their deposits insured have insurance on those deposits. They do serve as a primary and secondary supervisor. I have worked with them closely in my prior life, oftentimes responding to some of their MRAs, their findings, MRIAs, et cetera, on behalf of certain clients. They also deal with resolution. They have resolution authority under Dodd-Frank. They have they have expectations around recovery planning, exercises which probably are not as relevant to the group here today, but lessons within those tools should be considered and utilized regardless of the size of the institution. And last but not least, as we've learned and as they've reminded us, they manage receiverships of institutions. When I was first learning about bank failures, I read a lot of books about the failures in the 80s and what happened. They're re-engaged now more than ever, obviously, with what happened with Signature and Silicon Valley and several other institutions. And so they have a lot of experience in what we're dealing with right now. And they're not as at the forefront as the Fed and the OCC, but they do have a lot of quality people. They have a lot of good understanding of how to deal with these types of issues, and their guidance that is probably going to be forthcoming will color a lot of the bank regulatory and risk management practices that we'll all expect in the years to come. So obviously the CFPB sits on that panel, the OCC sits on that panel, and then 3 members from the FDIC itself. So they have that interagency experience. They have different needs of depositors and customers in mind, and they make sure to cover all those areas when ruling, when issuing regulations and rules. So if we could go to the next slide. What does the FDIC cover? This has somewhat changed a little bit in light of what's happened, but generally speaking, it's all the things you've come to expect. The checking accounts, the savings accounts, the money market deposit accounts, time deposits, negotiable orders, prepaid cards, etc. Things they're not covering should be used to all of this: stock investment bonds, crypto assets for sure, which became an interesting thing under the Voyager collapse, municipal securities, life insurance policies, and U.S. Treasury bills. Although U.S. T-bills have a different kind of backing, as we've all learned in the last few months, if we weren't fully aware, and that flight to quality has really benefited from the Treasury's position in all of this. If we can go to the next slide. The limits, we thought it was 250. We thought it was for certain types of accounts. Janet Yellen and the Fed and the FDIC have come along with maybe more guarantees, more implicit guarantees than we thought, just to stem some of the crisis aspects associated with what was happening. You have your single accounts, your joint accounts, your retirement accounts like IRAs, revocable trusts, employee benefit plans, government accounts, all insured up to that $250,000 limit, which has been temporarily suspended from what we've seen in Silicon Valley and Signature. I would not expect that the suspension of the limit to continue. I think that the 250 number is probably where the federal government is comfortable in insuring deposits, and for whom it affects, I think 250 is probably the right number. The electronic deposit insurance estimator, you can go there, you can find out if your deposits are covered. You can type in bank account information. It's a safe site. You can see exactly what portion of your money is covered right now in whatever bank account you hold it in. So it's a pretty cool site that you can tool around with. We want to jump to the next slide. The assessment, I would imagine that things are going to change after what's happened, specifically around how the assessment is tabulated. For small banks, the CAMELS rating plays a huge role. CAMELS is obviously capital adequacy, asset quality, management, earnings, liquidity, and sensitivity. When I first started, the gentleman I worked with, who was a large bank examiner, sat me down, took me through a UBPR, which is a Uniform Performance Bank Report, and started to grade CAMELS just from that document. Obviously, that's not comprehensive, but it is a good way to get an understanding of where a bank probably sits in that CAMELS rating system. That's confidential supervisory information. Banks do not give that information out. But if you learn to read a UBPR and a call report, you can get a sense of where the bank probably sits in that CAMELS rating system. Larger banks are obviously CAMELS rated, but also there are things that are looked at like unsecured debt, which is obviously given a preference, which decreases an assessment theoretically. Depository institution debt adjustments, which increases a potential assessment because of the interconnectedness aspects of that. And then the brokered deposit adjustment, which for many years and recently, I think as recent as 2 years ago, there were new brokered deposit guidance that came out, basically, again, warning people about the riskiness associated with using brokered deposits as a heavy funding source. And so, as you would expect, if you're using a lot of brokered deposits for your liquidity profile, you should expect to receive a higher than normal FDIC assessment. And that came to the forefront with, I think, Silvergate Bank, where they had a higher than expected brokered deposit adjustment. Brokered deposit funding base. And that ultimately was one of the reasons that they had to wind down. So if you want to move to the next slide. Oh, the call report. I would be careful. Much goes into call report filings. I think it's a view of a bank. I don't think it is the view of a bank. It is a snapshot in time. It is delayed by several months by the time you get it. And I don't think it's overly informative outside of certain key critical aspects that you'd be looking at, like deposits, for instance, like report of condition, report of income. I look at the investment portfolio. You can see some of the aspects of that. But again, if you're waiting for a March 31st call report, information was probably filed in February, and so it's a little dated, and that probably runs another 2 or 3 months beyond that. So just be mindful that it is a tool in the arsenal of reviewing a bank, but it is not the only tool you should be utilizing. If you'd like to, before we jump off this slide, you can get a decent estimation of uninsured deposits on the RCO. But just remember, it is not the clearest picture of what type of uninsured deposits exist at an institution. That's because they aggregate every dollar that's considered, that's in an account as uninsured, even if it's within the 250 limit. So you might be getting an overestimation of uninsured deposits on the RCO, and it's incumbent to not just rely on the UBPR, which is the Uniform Bank Performance Report, or the call report when estimating, the level of uninsured deposits for a particular institution. Another thing to note with institutions, smaller institutions, medium-sized institutions, uninsured deposits don't necessarily spell doom. There's a sensitivity analysis that goes on with ALCO and interest rate risk management and modeling that you should really be cognizant of. Uninsured deposits don't behave the same way at every single institution. And so there are things like historical deposit studies that would really color a bank's sensitivity to uninsured deposits. Certain banks may not see any run of activity from an uninsured deposit base. Others, as we saw, will see almost all of their uninsured deposits run off. It really depends on the profile of the institution, the customer base, the region. I mean, there's a lot of factors that go into why money would run in a particular situation. And I don't think this is as big of a small bank problem as it is some of the more, the larger and more regional banking institutions. So you might get a big number. You might see a big number. I wouldn't just say, oh my God, this bank is definitely going to fail if there's a run, because uninsured deposits are not created equal and they don't all run at the same time based on the institution. Julianne, is that a fair assessment? Okay, good. I wanted to make sure I covered this point because I don't want that to be the lone informational point that people use to say this bank is in trouble or not. If we can go to the next slide. So within the RCO, you can look at things like the deposit limits, the broker deposit funding sources, which I said. Again, this is another example. Broker deposits don't all behave the same way. They're a less stable funding source. They're not preferred by the FDIC, but they can be a portion of a contingency funding plan. They can be a portion of liquidity risk management, and they can be a portion of your overall deposit base. And as I said, again, uninsured deposits, similarly, you don't have to have all insured deposits as your funding base. You want to have a diversified funding base, a stratified funding base, so that you don't suffer from some of the problems that Silicon Valley or Silvergate or First Republic are currently experiencing. So if we could jump to the next slide. This is a pretty telling portion of the call report, the RCB. This talks about the duration risk potentially within a portfolio. Now, I know I came into the last talk and I heard someone was saying they don't mark anything as HTM, they mark things as AFS. And if you have most of your investments marked as AFS, this isn't necessarily a problem, but you can get a good picture of the type of duration risk that an institution might have just based on this particular section. So 3 months to 12 months, over a year, over 3 years, over 15 years, et cetera. You don't want to see in this environment, you don't want to see a large number of investments in buckets 4, 5, and 6. You would hope that an institution had a larger number of investments within 1 and 2, just because the longer the duration on a bond, the more sensitive it is to a particular interest rate rising scenario. And so that's what Silicon Valley, Silvergate, First Republic all experienced. They had duration risk on their balance sheet when they had to move those investments to from hold to maturity to available for sale to cover some of their uninsured deposit flight. That's when they started to take hits against their capital. And so, I would want to know, if I was a smaller bank or a medium-sized bank, what if I have to move my investments from HTM to AFS? What happens? I would look at that as part of my liquidity risk management program. I'd want to understand just how much capital I'll be taking a hit against. If you're doing this prospectively, you could probably raise enough capital to save your institution and not have to convert out of these bonds. Again, if you can hold bonds to maturity, the losses are not necessarily realized against capital. The problem is if you have to convert them quickly, it's a vicious cycle, and you'll actually hit enough capital to potentially go out of business if you have to cover enough uninsured deposits. So I look at this as another guidepost. It's not the only guidepost, but if you're going to look at uninsured deposits and broker deposit base, you also should be looking at duration within the investment portfolio. It'll give a good picture of the potential risk that an institution may deal with. Again, though, depending on the classification, may not be as a big deal as it was for certain institutions that had issues over the last few months. you want to jump to the next slide. And I don't know if there are questions coming in, Ian and Julian. So if there are, obviously direct them to me. I can hit them along the way if there are questions.
Yeah, there's one that did pop up. Didn't the FDIC cover all the deposited banks in the 2008 liquidity crisis? Can we just assume the regulators will force mergers and have the FDIC cover all depositors?
Well, that's a really complex question. I don't remember if the FDIC stepped in and guaranteed all deposits. I think it was also a more limited problem in the larger banks, where this is potentially a bigger problem for the medium-sized banks. So there's more banks and more deposits at play here that may require a guarantee just based on the environment. So I think 08 was more of a big bank problem. This is more of a medium-sized banking problem. So it's more of a broad issue than what we saw in 2008. The other part of the question was, can we expect the government to just merge through? You need to find viable partners. The administration doesn't really favor mergers and acquisitions right now, and so that's creating a bit of a challenging environment. I know they changed some of the rules around what's a potential merger target, what's a potential acquisition. I wouldn't necessarily rely on a merger. If your bank fails on a Friday and they have to merge it over a weekend, that's not the best way to find a viable partner. That's not the best way to be merged. And in this environment, there may be less merger candidates than you would think, just based upon the risks that we're seeing on balance sheets. So I hope that answered the question. There's probably a follow-up to that. I'll happily draft a follow-up if you have any questions. But does that, Ian and Julianne, does that answer the question?
So. I think that covers the basics. We got a follow-up.
Okay.
We'll let you know.
Okay, great. So the topic of the day, the topic of the month, interest rate risk and asset liability. I mean, before the Fed started to actively intervene in the interest rate environment, you could, take on deposits at, let's say, 3%. You can lend them out at 6%. You could be home by 5 o'clock. That was the old joke. As the Fed, dealt with some of the financial crisis externalities from 08, it had to bid down the Fed funds rate. It had to buy up longer term treasuries and mortgage-backed securities, et cetera, to try to engage in some yield control, to try to help the economy, to try to support the economy just based on what happened in 08. This created a difficult situation if 20 to 30 to 40% of your bank's balance sheet relied on investments rather than loan demand to generate net interest margin. And so over the years, you were buying lower yielding bonds. You probably weren't making as many loans as you would have liked. And you get to this problem of when you have to rapidly raise interest rates, you have an issue where you can't possibly pay the depositors the Fed funds rate, the prevailing rate on the front end, and you're not making the loans, the large, the high interest loans to cover the differential, and you're not in a great business model at that point, where you can't pay 6%, you can't make a 9% loan, and so you have a bit of an issue. ALCO modeling, interest rate risk modeling, was designed to understand a bank's sensitivity to that mismatch, that maturity mismatch. And so I think there's going to be changes in expectations around interest rate risk and asset liability management modeling. I think there has to be. For many years, people relied on historical deposit data to then model sensitivities to rate shocks, certain rate shocks. If you're paying attention, I think we've seen over 500 basis points in 14 months. I think when I was doing the modeling, it was an immediate shock of 300 basis points. So I think there needs to be some work on, modeling that incorporates not necessarily an immediate rate shock, but maybe a large rate shock over a shorter period of time than historically acceptable. I think we used to model the 04 to 07 run up, which was about a 400 basis point run up, to test some of the liquidity issues that we might face as banks. But I do think that this is an area that's probably going to be modified in light of what's happened to more accurately reflect what a very short-term interest rate shock environment might look like. And so I think you have to throw in some assumptions that don't necessarily mimic, your historical core deposit and uninsured deposit and broker deposit reactions to some of this shock. And so your sensitivity testing is probably going to change. Some of the stickiness assumptions associated with your deposit base may change. Now, if you do lookbacks, which are recommended, and you're just not seeing your deposits flow out in this rate rise environment, then maybe your historical deposit studies are fine. But if you do notice some sensitivity to deposits, you probably should be incorporating more real-time impact to your interest rate risk modeling, because it'll be more of a valid forecast, more of a viable forecast for your interest rate risk sensitivity that you could experience relative to your capital position, relative to your net interest income, et cetera. So I'll pause there. I don't know if there are any questions, Ian and Julianne, around this topic, but I think this is a forward-looking area where I would be focusing if I was in a small bank, modeling assumptions, potentially just looking at what has happened and incorporating on a go-forward basis. Okay, if we want to jump to the next slide. This is what I was talking about relative to deposit studies, new methods of obtaining deposits, maybe changing some of the frequencies associated with the runoffs. As I was saying earlier, the smaller banks with the uninsured deposits, they may not experience what happened at Silicon Valley Bank. So maybe instead of 100% runoff, you would look at a 30 or 40% runoff if your historical runoff is 10% relative to the interest rate environment. So I think the regulators will, even if they don't give guidance, which I expect they will, they'll want to see you looking at your historical assumptions differently and maybe applying more aggressive runoff to certain of these problematic funding sources. So not really your historicals, because you probably have a good idea of your historicals, although you could get more aggressive. You could be more conservative with what money you would expect to stay if the rates continue to go up. You want to look at different rate shock environments, longer duration rate shocks, changes in the yield curve. I think that's something you should be considering just based on what the yield curve might do in the next 12 months. Depositor behavior, as I've referenced, and then asset prepayments. As rates were falling, your loan portfolio was probably paying down faster, and you could expect more turn in money, and then you'd have to put it back out. I think if a lot of people are sitting on 3% mortgages in a 7% mortgage environment, you must slow down those prepayments. And you must expect that you're going to have a slower drip liquidity flow than you have had in the past, maybe over the last 10 or 15 years, which would impact the types of decisions you make relative to the types of risk you might take, at least on the interest rate risk front and duration risk front. You may not be so willing to go out longer on the curve to get some interest rate pickup if you know that your mortgage portfolio is going to slow down dramatically over time. So this is a key area now. It's become a key area. I expect that whatever happens next, this area will be a huge focal point for every institution, whereas for many years it kind of languished. It was kind of second fiddle to the credit risk modeling that people were doing. But I think now with the potential for more rate hikes or rate cuts, depending on how the economy moves, just based on what the Fed's been doing, I think you have to be more dynamic and more aggressive in the types of assumptions you're applying to your model. And if you have a third party, which I know when I worked with the smaller banks, they had third party models they were using, I would be very proactive with approaching my modelers, my third party modelers. The firm I worked for did a lot of the modeling for our clients. I think that in this environment, you have to be giving a lot more feedback than in the past. I think that'll be an expectation of the FDIC and the NCUA and the OCC that you're not just saying, oh, our firm that models us, they have a good handle on what our issues are. I think you'll have to give some input modifications to any third-party modeling if you're doing it out of house.
Mike, it's curious to see what you think about, gaming out the regulators a bit here. While this may be an interest rate and liquidity kind of problem, is the response from the regulators like automatically go to, we need more capital? Or will they go to a more nuanced approach of we need to look at risk management?
So capital is one of those challenging areas in this type of environment, right? When you need to raise capital, you often can't. So I don't know if the regulators are going to say this is a capital problem. They might say this is a modeling problem. This is an assumption problem, or maybe the capital, the way we measure capital is inadequate, because as far as I'm aware, and the work I've done when I was at my prior firm where I was the capital expert, it's all credit risk. There was never an inclusion of interest rate risk in any of the calculations. It was considered if you had a Ginnie Mae, if you had a Fannie, if you had a Freddie, you were going to take 0 to 20% capital hit, and that was going to be it. But if you're holding a 10-year Ginnie, you have a problem. Yeah, there's no credit risk component because the government's backing it, but that bond is underwater right now because of where the interest rate environment has gone. So I'm not sure it's a capital problem per se. I think we have to continually modify our assumptions relative to our models to keep up with this new and ever-changing rate environment. And it's both in the loan portfolio and in the investment portfolio and in the deposits. Like what you were able to rely upon in the last 10 years has changed. It's just a different game now. And all assumptions are subject to review and potential modification.
Great. Also, just to tell the attendees here, please keep the Q&A questions coming, and we'll integrate them into the discussion.
I just have a quick question. I just don't want to forget it for later, Mike. You mentioned the interest rate shock assumptions are for usually plus 100, plus 200, plus 300.
Yeah,
you're right. We've seen plus 500. Has the 10Ks are still to come out, but did banks change that over the past year? Did they change the?
No, I don't think they have. I mean, I certainly would be modifying those assumptions, seeing what a 400 rate increase would do, 400 basis point rate increase would do, and then I would make my decisions, based on that. Or I would also be thinking about the potential for a drop of 200 basis points. I mean, if you're paying attention to the news, if any more issues arise in the banking sector, the Fed might decide to cut rates. They might decide to cut rates dramatically, and just because they're cutting rates doesn't mean your balance sheet is safe. You could be sensitive to a down rate environment that you were unaware of. So we might have hit a peak on interest rates. I'm not going to prognosticate on that because I just don't know what the Fed's going to do next. But it's certainly time to think about what if we get another 100 basis point increase? What is that going to do to your balance sheet, your portfolio, your loans, your deposits? And what if we get a down 100 rate environment? You should know that answer.
You'll be looking for those tables right in the 10Ks.
Exactly, the EVEs and the NIIs. We want to go to the next slide. Liquidity risk management. I think that there was probably not enough attention paid to liquidity risk management over the last 10 years because of how easy it was to raise funding and how cheap the cost of funds were. And as you all probably know, if you're over 50 billion, you have these enhanced prudential standards, you have these internal stress tests, you might even be subject to the Fed stress test if you're large enough. If you're 10 to 50, you might need a risk committee around liquidity. If you're under 10, you're exempt from all of these things. Personally, in this environment, I'm not sure I'd be exempting myself from stress tests. I know when I worked with some of the smaller institutions, it was good enough to say, these are our 6 scenarios. If these things happen, these are our order of operations. This is what we'll do. But I would start to play around a little bit with my liquidity risk modeling, cash flow projections, as I mentioned. Am I diversified enough from a funding source standpoint? Think about unique stress tests. I mean, I talked to a lot of the big banks around what they could be doing outside of what the Fed recommends. Maybe consider a huge counterparty failure. If you have a counterparty concentration, what type of assets are really truly liquid in this environment? And then, your contingency funding plan, how many sources of external funding in what environments will be available to you in the event of certain stress scenarios? I think this is another area where the regulators might say, this needs to be more dynamic. You need to take a more active role. You can't just rely on the store-bought modeling aspects that we've all relied on for the last 10 to 15 years. I mean, in the smaller institutions, this really falls on the CFO, and the larger institutions more on the treasurer, but there should be someone with a good understanding of what their options are. We've heard a lot about the FHLB. If you asked me in 2013, if I would write in my contingency funding plans that FHLB access was available and that you could pledge and you could get certain funding. I didn't think the FHLB expected $60 billion in requests for funding. Granted, they met those expectations, but I think even the FHLB was strained just based on all the demands that were coming up. And I know for certain clients, the FHLB, reduced credit lines. So it leads to the question of if the FHLB is a contingency funding source for you in a situation, an adverse scenario, can you rely on your existing credit line with the FHLB to get the money that you need? The Fed discount window, that's another one. That's a short, very short term and not really favored by the Fed itself. It's there, it was available. It's used when I was back in 13 and 14, and this may have changed, it was a day facility. It wasn't a long-term facility. FHLB was a longer-term facility that could be relied upon. We also have this bank term funding program, which I'll talk to in more detail. I don't know how long this BTFP is going to exist. It may be a year, it may be longer, it may be made more permanent. But essentially, that's another area of incorporation for your contingency funding plan, for your liquidity risk management. You might say, hey, there's another government program, I should incorporate it. And not only should I incorporate it into my written documentation, I should test it. I used to tell my clients, even if you don't use the FHLB line, call them up, pledge some securities, see if it works, see how long it takes to get the funds. What's the operational aspects associated with it? What does the application look like? You do not want to be rushing to the FHLB having never tested your facility when you need the money. So not only writing it down and having the playbook, but also reaching out, testing the facility, making sure it's there, making sure you understand how it works in times of turmoil or emergency funding. Any questions there? Okay, so the BTFP, it was interesting. It's a as of right now, you can pledge any underwater security that's high quality, U.S. agencies, treasuries, etc. For up to a year. You can get a favorable rate from the government, and they'll actually give you a loan, as I understand it, against the full value of the instrument. So you won't have to take a haircut due to mark to market. You will actually be able to pledge your security at par value and get the funds that you need. Now, why did they choose a year? I have no idea. I would have probably lengthened it. Why do we think that if this interest rate environment continues, that in a year these securities will be in any better position? Maybe the Fed, and this is the conspiratorial aspect of it all, maybe the Fed is telegraphing that in a year it expects interest rates to be lower and this to be not necessary. I don't know the answer, but I know that it's a year long. They're taking very high quality liquid assets that might be impaired right now due to the interest rate environment. They're lending against them at full value, and they're giving you a more favorable rate than what it feels like in the private markets. And that's what the chart on the right is showing. Any questions on this? So, I mean, obviously everybody knows that, why Silvergate, Silicon Valley got in trouble is they had to sell very quickly underweight securities and immediately take those losses against their capital position. This program stops that.
So Mike, though, it will be tricky, when modeling the net interest margins of banks to really pay attention about what they're drawing down, because this is obviously going to be more costly than probably their current funding.
Oh, without a doubt. I mean, I remember the years of like 60 basis point funding. Like that was, those days are long gone. You'll have to reincorporate a much higher cost of funding over time as a good practice to make sure that you can meet your margin requirements, that you're not compressed too heavily just based on the fact that you might have to lend it for. You're taking a loan at 4.69%. Are you writing enough mortgage loans at 7% to justify that cost? Who knows? I mean, we just don't know. That's why you have to model out your cash flows. That's why you have to slow down your prepayments. That's why you have to get more aggressive in terms of what your assumptions should be. But I would expect margins to compress. I mean, I think that's one of the big problems we're going to see. Unless somewhere out there people want to take an 8% mortgage, which I'm not really sure. And then, The second issue, and I came into the end of the last talk, I know a lot of the commercial, portfolios here are specialized and diversified and outside of the problematic areas. But what happens if we start seeing, huge mortgage portfolio losses? And what happens if, the real estate values take a tumble due to this ever increasing interest rate environment? It's really important to point out that the Fed has done 6, 7 interest rate hikes. We're probably only feeling half of them right now. They take a long time to work their way through the economy. And so we just don't know what the new Fed funds rate is going to do to borrowing, to lending, to real estate, to auto loans, to credit card portfolios. It hasn't been fully baked in a lot of places. And so, from a credit modeling standpoint, I think you have to assume a more aggressive loan loss provision, because I can see people being unable to refinance and defaulting. That is a potential risk here. Want to move to the next slide. I started talking about this earlier. The FDIC has experience in resolution. It is the resolution authority based on Dodd-Frank, and even before that. It generally steps in. It has 3 options usually. It tries to spare depositors any losses. It tries to spare its own fund losses. It tries to find a buyer who will pay full value for the assets that exist and make sure that everybody comes away whole. I don't think the fund has taken very many losses, if at all, the FDIC's insurance fund. That may change if failures start to cascade and there are a lot more happening that it can possibly cover in a short period of time. I know in 2008, the federal government had to step in and increase monies to the FDIC because of how much potential funding was at risk just based on the potential bank failures that were occurring or could occur. And so FDIC has this resolution authority. I highly recommend looking at some of these scenarios that the FDIC looks at and evaluates, whether it's credit risk, operational risk, reputational risk, what have you. Even applying what happened to Signature and Silicon to your own institution and seeing how that might play out and having a plan of attack if it does. It's a good practice, even if it's not an expectation right now. If we want to go to the next slide. I scoured the internet to see if the FSOC has opined on any of this. I know they've been meeting. I think on Friday they had an emergency meeting. It was behind closed doors because of the potential for certain larger institutions to come under some funding stresses. I expect the FSOC to issue guidance. The FSOC is the Penn agency council that was created after 2008 to address a lot of the systemic risks within the financial system within the US and globally. And so I would expect there to be a lot of issuance in the next few months from the FSOC directly around what happened, new expectations, liquidity risk management, all the topics we discussed today. So I keep an eye out on that. I know the FSOC is really focused on the systemically important institutions, but oftentimes there are practices that can be taken from the SIFIs and the GSIBs that are probably good practice to incorporate into your institution. I'm not saying you adopt a full resolution plan. I'm not saying you adopt a full recovery plan, but thinking through some of the things that the larger banks have to deal with and incorporating it into your contingency funding and liquidity risk management, probably a best practice. And I do expect areas of that to be enhanced depending on the size of the institution. If we want to go to the next. So interestingly, and don't laugh, the NCUA, I worked with the NCUA a lot when I was back at the broker-dealer as well as the FDIC. The NCUA started to think about interest rate risk in addition to credit risk when it evaluated the risk to a financial institution's capital. And so the NCUA gave certain authorities to its examiners to revise risk classifications, to revise documents of resolution, to assess risk based on the duration of the investment portfolio or the mortgage portfolio, et cetera. So the NCUA armed its examiners with the ability to say, you know what, you might only have high quality government bonds, but I think there's another risk we need to consider, let's have our examiners get some flexibility and apply a supervisory test to see what would happen to you in the event of what we've just seen. I don't expect the FDIC to adopt what the NCUA has done wholeheartedly, but I do expect that the FDIC is going to look at that supervisory test and figure out what works for its institutions to incorporate some of this interest rate risk that to date it really doesn't incorporate into its own capital calculations.
Hey, Mike, just a question. There's been a lot of credit union mergers of banks, and
Yeah.
the bank investor community like talks about that a lot.
Yeah.
Is the NCUA more likely to support an acquisition of a bank in this environment than maybe the FDIC is in banks buying banks?
So my experience with the NCUA is outdated. I haven't worked with the NCUA since 2014. The NCUA was a lot more rigid in 2014 than what I've seen. I have noticed, and I do have a mortgage with a credit union, I'm sorry. I noticed that they were allowed to expand their charter, expand their footprint. It was a lot different than what I was used to. To me, the NCUA was a lot more rigid, 10 years ago than it is now. I don't know how that's going to factor into the acquisitions and the mergers, but it seems like the tone at the NCUA has changed a little bit to be more competitive with the banking environment. And I know that some banks have voiced their concern about, the NCUA and infringing upon, bank territory and bank charters and all that. So I don't know the answer per se, but I'll say this. The NCUA kept the credit unions in a very rigid position for a long time when it came to interest rate risk. So as far as I'm concerned, and this is just my hypothesis, the credit unions probably were not in as bad shape when rates started to rise, because they were overtly told back in the day when I was working with them, do not go out longer than 5 years, 7 years, etc. Keep your portfolio short, keep your loans short. Like, they were so afraid of interest rate risk 10 years ago. Who knew it would come to fruition in this way? But now this supervisory test is a little anti-competitive from what I hear. So it's a balance. I think that the FDIC is probably going to look at some of the NCUA's practices to see what might work and what won't. But I don't really know how the NCUA is going to look at mergers and acquisitions. I think the tone at the top is mergers and acquisitions are bad in banking, which I don't particularly understand. I think that mergers and acquisitions are natural and normal and should be allowed to progress through a process. But I know the administration has taken a different stand on that. This is the supervisory test I was pointing out. They have different steps for different size institutions on the NCUA side. I point this out only because it could be utilized with the FDIC. The FDIC can say, if you're above a certain size, we'd expect you to look at these things, this type of capital at risk measurement. So like a lower tier, a middle tier, and an upper tier. And obviously, the higher up, the more billions you have next to your name, the more expectations for capital at risk and applying some kind of a supervisory test to understand what your true interest rate risk exposure is relative to EVE and NII. And then this is just a graph of how the supervisory test can be applied, the percentages, the expectations. So as you can see, the NCUA is much more rigid and prescriptive with what it expects to see when it comes to net economic value, which is their version of economic value at risk. So the EVE calculation that we're all used to. So just something to think about, just for a potential guide as to what you might see, just based on the fact that interest rate risk wasn't really considered by the examiners in a formal test in years past. Now, I'll open up for any questions. Anything I don't get to, I'll happily follow up with. I hope that was informative. There was a lot to cover. There's a uniqueness to this environment. So if there are any questions, I'm happy to address them now.
So I'm going to give you a big, broad one. What's the path out of this current? Is other than just time, is there, is it lowering rates is really what's needed, or is it,
We-
so from the point of view of putting a hat on as an investor in these
Yeah.
banks, what are some of the things that, you might be looking for to see that things will be improving and turning?
Looking at things like margin, looking at historic margin, looking at cost of funding. I mean, you could still apply the fundamental principles to a bank that you might consider investing in. You might, obviously, you'll look at the funding sources per se. You'll look at the investment portfolio, as I pointed out. You look at the allowance for loan loss. I mean, the rules of financial risk management still apply. You just might have to look at banks somewhat differently than you've looked at them in the past. I think for 15 years, banks got used to low rate environments. And I would not be looking at banks from that perspective any longer. I would not expect aggressive rate cutting in the near future. And so we're going to be in this environment for a long time. And who has the aggregate loan demand? Who has the cash right now to go out and make the loans? What is their investment portfolio yielding? All the questions I would be asking if I was looking to invest in a bank right now. Who has maximum flexibility relative to the environment? If you have maximum flexibility, if you're not stuck, if you're not loaned out and and in a horrible upside down investment portfolio, you might be a good buy at this point.
Julian?
Right. Yeah. No, those are good thoughts. And I think I don't have any other questions. Do you, Ian? I think
No, I think we hit the time on the dot pretty
then we
much.
hit the
But I would encourage, I guess, I'll take you up on your offer if anyone in our audience here comes up with some questions that you will forward and
Yeah.
say.
Yeah, and my firm is, we're working with distressed institutions, and we have many tools in our arsenal, many really talented subject matter people. This is what we all waited for our whole careers. I mean, risk management was boring for a long time. Now it's super exciting, and I think all risk management requires a new approach, a different approach than what worked in years past.
Very good. Well, thank you so much.
Yeah,
Yes,
thank
thank
you.
you. Yeah, thank you.
You're very welcome. Take care.
Thank you. All right. And so Ian will just
Yeah, when we wrap.
we'll just say thank you right now to everybody. We'd like to thank you, Mike, and to thank Simone, our speakers, each of our 5 presenting California banks who seem to be doing just fine, to be doing really well with deposits and their real estate valuation outlooks. We appreciate all of you attending. Thank you so much. It means a lot. We'll keep you posted of future interviews, future conferences. We'll have recordings of today's session that will be available within a day or two, and we'll follow up with an email. So how to access that. Again, you can access the company's one-page at-a-glances on our website. I forgot to mention at the beginning, but I've done the calculation of adjusting for any held to maturity unrealized losses, which for most of our California banks, there was nothing. They really didn't have any, but it's in there. And I've also adjusted for what's already in book value, which is the AOCI marks or the available for sale losses. Those are unrealized, but have been realized in the book value. And so I've adjusted for that as well in the at a glance. And those are linked to the website, as well as the company slides will be up there within a day or two. So Ian, did I catch everything?
I think you did.
All right.
So continue to check our website and our emails and so forth for different events and information that we'll be providing as the year goes on. Thank you very much.
Good. Thank you. Bye-bye.